Hi, this is Steve Dale, and today I want to talk about the new revised ABLE Act POMS that were released just recently here. Now, to find the POMS we're going to talk about, you can do it a number of different ways. One is if you go to policy.ssa.gov. Here, it will take you to this page, which is the home page for the POMS. If you look to the left, you'll see something that says POMS Recent Changes. That will take you to this page. Now, these POMS were released on March 8th, 2018 under a title called Resource Exclusions. So if you hit that bar there that says SI01130 here, that will take you to the POMS we're going to be talking about. The other way to do it is if you go to Google and you were to Google SI space 01130.740, that will take you to the actual POMS itself as well. So part of what we're going to talk about here are the changes that were made to the existing POMS and some of the update. We're going to cover some of the updates, but we're also going to cover some of the basics here. So we're going to cover this section by section. So Section A basically says that we identified the various partnerships the states can use to administer ABLE accounts, and we address the treatment of duplicate ABLE accounts. So in the POMS here, what it says is an Achieving a Better Life Experience, or ABLE account, is a type of tax advantage savings account that an eligible individual can use to pay for qualified disability expenses. The eligible individual is the owner and the designated beneficiary of the ABLE account. And we're going to see that over and over and over again. An eligible individual may establish an ABLE account provided that the individual is blind or disabled by a condition that began before the individual's 26th birthday. So, an ABLE account can be established only by a state or state agency or instrumentality of the state, and it can be done in a number of different ways. Some states have formed partnership to put these together with other states. Some states have formed a consortium of different states joining together. Some states establish their own ABLE programs but have contracted with private companies. Some states establish their own ABLE programs but contracted with other states to manage the ABLE program, and some states do not operate their own ABLE program but have partnered with another state to offer the other state's ABLE program to their residents. That's not covered in this POMS, but even if your state, such as California at the time of this taping here, doesn't have their own ABLE program, there's many ABLE programs you can join here. So if the question is, when are ABLE accounts available in your own state, the answer is they've been available for quite some time. So a designated beneficiary, and they're trying to make the point that you can only have one ABLE account by law here. So a designated beneficiary is limited to one ABLE account, and except in cases of a rollover or a program-to-program transfer, if a designated beneficiary has an additional ABLE account, it generally will not be treated as an ABLE account and will be subject to normal resource counting rules. So this would be something along the lines that my wife and I set up an ABLE account, for instance, for our niece here. But what if another aunt and uncle opened up another ABLE account for the niece, not knowing what we did in another state? You're only allowed one ABLE account. And what's going to happen is that Social Security will give you 90 days here from the time the account was open to go ahead and close it and ideally merge it into the other ABLE account. Now, one thing that's unique about ABLE accounts is that there's a lien for any Medicaid use from the time the ABLE account was established. And on my YouTube channel, we actually have a video on Medicaid liens and ABLE accounts. What they've added to the POMS is that some states here have actually passed state legislation that they may not file a claim for reimbursement. As of this taping, California, Oregon, and Pennsylvania have actually passed their own laws saying that if you use their programs, then it won't be subject to a lien in their state. It still means that if you've used Medicaid in other states, that may be subject to a lien depending on the situation. Section B goes over that there were changes made to references for QDEs or qualified disability expenses for housing and housing expenses, and they also updated that you can contribute up to $15,000 a year into an ABLE account. So let's see what that says. Basically what it's saying for contributions is that contributions have to be in cash, and they can be in the form of a check, money order, credit card, electronic transfer, or similar method, and any person can contribute to an ABLE account. Now, because the IRS actually says that a trust is a person, it's clarifying that that transfers to an ABLE account can be done by a trust, and we're going to see more of that later. Also, it clarifies that the ABLE account can have up to $15,000 a year transferred into the account, up from $14,000. And what that is based on is contributions are based on whatever the gift tax exclusion is for that year. Last year it was $14,000. This year it's $15,000 because of a cost of living increase. So as far as designated beneficiaries are concerned, a designated beneficiary is the individual that owns the ABLE account or has an eligible individual where the account was established or who succeeded the former beneficiary in that capacity. To be an eligible individual, he or she must be eligible for SSI based on a disability or blindness that began before the age of 26, or entitled to disability, one of the disability insurance programs here, or childhood disability benefits, or disabled widows or widowers benefit based on a disability or blindness that began before the age of 26. Or have a certification here from a doctor, and that can be gotten by the individual or an agent under a power of attorney or by a parent or guardian to get the certification that he or she has a medically determinable impairment meeting statutory specific criteria or is blind, and the disability or blindness occurred before the age of 26. Now, where this is useful is, for instance, for many folks with mental health issues. It may be that the mental health issue began well before the age of 26, but maybe that person didn't start getting benefits until they were 28 or 30. By getting a doctor certification, you could still qualify for an ABLE account. Now, what it says here is to not draw the inference just because you have the certification that you automatically qualify for SSI, for instance. You're still going to have to go through the same process to qualify. As far as distributions are concerned here, a distribution is a payment from an ABLE account. And what it's going to be clarifying, and we're going to see more about this later, is that a program-to-program transfer is not a distribution. The designated beneficiary or persons with signature authorities determine when a distribution is made, and distributions other than rollovers and returns of contribution can be made only to or for the benefit of the designated beneficiary. Now, we're going to see later that there is that you can make transfers if you have a family member that's disabled and still was disabled before the age of 26 here. But when they're defining family, as we'll see later, that means a sibling, whether by blood or adoption, and that includes a brother, sister, stepbrother, stepsister, half-brother, or half-sister. When we get into this further, notice it doesn't say child, it doesn't say spouse, it doesn't say parent. It's strictly for siblings for this transfer that we'll see later. Persons with signature authority. A person with signature authority can establish and administer an ABLE account for a designated beneficiary who is a minor child or is otherwise incapable of managing the account. Signature authority is not the equivalent of ownership. So for instance, you could have somebody who is on SSI administering somebody else's ABLE account, and it shouldn't interfere with their benefits because they don't own it. the person with signature authority must be the designated beneficiary's agent under a power of attorney here if the person with the disability is not going to take control of it themselves, or if none, a parent or legal guardian of the designated beneficiary. They're always going to assume that the able beneficiary is competent, but if they're not competent, then it can be managed, or a minor can be managed by a parent or legal guardian. For SSI purposes, always consider the designated beneficiary to be the owner of the able account, regardless of whether someone else has signature authority over it. This goes back to the example. You could have somebody who's on SSI who is the who has signature authority over, let's say, their child's able account if their child is disabled, and it's not going to interfere with benefits because the parent on SSI in that case doesn't own it. They're only controlling it for somebody else. As far as program-to-program transfers, a program-to-program transfer means a direct transfer of the entire balance of an able account to an able account of the same designated beneficiary in which the first able account is closed upon the transfer of the funds, or part or all of the balance of the able account for the eligible individual is a member of the family of the designated beneficiary, keeping in mind we're talking about siblings. Now, where this would come in is, let's say you opened up an account in Ohio, for instance, and when California has its program up and running, you wanted to transfer your account to California. That would be a program-to-program transfer, and as long as the entire thing is transferred, that is permissible without interfering with your benefits. Now, here's something relatively big. In most of the presentations we would go through what all the qualified disability expenses are here, which you can see listed. But you'll notice on the bottom, what was added is basic living expenses. This has broadened the use of ABLE programs dramatically. The question always came up, if you look at the other things listed, well, what about food? What about clothing and that kind of thing? If you can justify it as a basic living expense, it's probably a permissible QDE. Now, whenever you're making distributions for housing, we always keep in mind, and what you're trying to avoid is what's called the ISM reduction when you pay for food or shelter. There's a video that we did earlier on paying for housing with an ABLE account, but what we showed is in many cases of outside assistance, if you help somebody with their housing expenses, which includes these 9 items here, their SSI benefits will be reduced dollar for dollar, capped at 1/3 of the federal part of the SSI plus $20. What this is saying here is that the housing expenses that SSI usually counts are these items, and as we're going to see later, that if the payment for these things is made through an ABLE account, it's not going to reduce their SSI benefits for housing. Once again, if you want to learn more about that, go back to the playlist and look at the video we did on housing for ABLE account owners. But this is a huge benefit of using ABLE accounts for many people on SSI. In Section C, they clarified the treatment of contributions to an ABLE account. So when we talk about that they exclude contributions as income, a payment made into an ABLE account constitutes a contribution. Consider the contribution made by the person to whom the funds belong or are due. Exclude the contributions to an ABLE account from the income of the designated beneficiary, and excluded contributions include rollovers from a member of the family's ABLE account to an SSI applicant, recipient, or deemer's ABLE account. Note, the fact that a person uses his or her own income to contribute to an ABLE account does not mean that his or her own income is not countable for SSI purposes as it normally would be. Income received by a designated beneficiary and then deposited in his or her ABLE account is income to the designated beneficiary. For example, an applicant, recipient, or deemer can have contributions automatically deducted from their paycheck and deposited into an ABLE account. In this case, you're still going to take the normal reduction for earned income here but the contribution here of the contribution. So a contribution made by the designated beneficiary to his or her ABLE account is not income to the designated beneficiary. However, income received by the designated beneficiary deposited in his or her ABLE account is income to the designated beneficiary. That is, the income is income in the first instance, but the contribution is not income. So an individual cannot use direct deposit to avoid income counting. So when a payment that belongs or is due to the ABLE beneficiary is direct deposited into his or her own ABLE account, the payment is considered to be received by the designated beneficiary. It is counted as income to the designated beneficiary as it otherwise would be, and the designated beneficiary is considered the contributor for ABLE purposes, and the ABLE contribution is not considered income to the designated beneficiary. That's one heck of a run-on sentence. So here's examples of payments that might be direct deposit into an ABLE account, but they're still going to be counted as income as they otherwise would be. And they include wages, benefit payments, for instance, from Title II benefits, veterans benefits, pensions, etc., and mandatory child support payments or alimony. Just as an aside, there's a POMS that's made it clear before that if you have child support or alimony that is irrevocably assigned to a self-settled special needs trust, that's not counted as income. So if you had a situation where, for instance, you had child support irrevocably assigned to a self-settled special needs trust, and you wanted to turn around and get the benefit of making the payment through an ABLE account for housing, you would have it go through the special needs trust, and then the special needs trust trustee would make the deposit in the ABLE account and then make the payment for the housing and would get the same effect. This, quite frankly, here saying that you can't use it for mandatory support payments is kind of sad, but that's the way it works. It also says to exclude a distribution for a qualified disability expense not related to housing from the designated beneficiary's countable resources if he or she retains it beyond the month received. This exclusion applies while the designated beneficiary maintains, makes contributions to, or receives distributions from the ABLE account. The distribution is unspent. The distribution is identifiable here, and the individual intends to use the distributions for a QDE not related to housing. Note, normal SSI resource counting rules and exclusions to assets or other items purchased from the funds of the ABLE account still apply. So third-party contributions are contributions made by persons other than the designated beneficiary. Further, the third-party contributions are made with funds that do not otherwise belong to or are not otherwise due to the designated beneficiary. That is, they are made with the third-party funds. Accordingly, an ABLE contribution by a person other than the designated beneficiary is treated as a completed gift. This is fairly big for the special needs trust industry, that it transfers of funds from a trust of which the designated beneficiary is the beneficiary and which is not considered a resource to him or her to the designated beneficiary's ABLE account generally will be counted as third-party contributions from ABLE purposes because the contribution is made by a person or entity other than the designated beneficiary, namely the trustee, and because the designated beneficiary does not legally own the trust. And it also says that you can seek guidance, and remember, this is speaking to the eligibility workers, so if they have questions, they can go to the regional trust leads for this. This is pretty big for the special needs trust industry, basically saying that a trustee can make distributions into the beneficiary's ABLE account, and that is absolutely permissible. So, a distribution from an ABLE account is not income, but it's a conversion of a resource from one form to another. And it says, do not count distributions from an ABLE account as income of the designated beneficiary, regardless of whether the distributions are for a QDE not related to housing, for a housing expense, or a non-qualified expense. What it's basically saying is whatever the beneficiary uses it for, as we're going to see with some exceptions, it's not going to count it against the SSI. There may be penalties, tax penalties, and that sort of thing, but that's under the Department of Treasury, and Social Security and also Medicaid is not going to oversee this, and they're not going to count distributions from an ABLE account, as we're going to see with some exceptions. Excluded distribution for a qualified disability expense not related to housing from the designated beneficiary's countable resources if he or she retains it beyond the month received. This exclusion applies while the designated beneficiary maintains, makes contributions to, or receives distributions from the ABLE account. The distribution is unspent. The distribution is identifiable here. And the individual intends to use the distribution for a qualified disability expense not related to housing. We're going to see a big exception for housing coming up. Note, once again, apply normal SSI resource counting rules and exclusions for assets or other items purchased. A good example is that on SSI you're allowed one vehicle, but you can't use an ABLE account to buy a second vehicle and have it not counted. Examples of excluded distributions. Eric takes a distribution of $500 from his ABLE account in June 2016 to pay for a health-related qualified disability expense. His health-related expense is not due until September, and Eric deposits the distribution into his checking account in June. The distribution is not income in June. Eric's distribution is both unspent and identifiable until Eric pays his health-related expense in September. Exclude the $500 from Eric's countable resources in July, August, and September. Seems pretty straightforward. Fred takes a distribution of $15,000 from his ABLE account in September 2016 to buy a health-related item that is a QDE. The item is an excluded resource in October and continuing because it is the individual's personal property required for a medical condition. So here's an example where the funds were used to buy something that was exempt. When to count ABLE account balances and distributions. Count the amount by which an ABLE account balance exceeds $100,000 as a resource of the designated beneficiary. Individuals with ABLE accounts can maintain eligibility for means-tested programs here, and so a concept that we went through in the basic program here, we're just talking about changes in the POMS, but a basic concept is for people that are on SSI, as long as the ABLE account is below $100,000 here, it's not going to be counted against your SSI. Once it goes above $100,000, it will start to be counted as a resource, and as we're going to see, eventually the account will go into suspension if all other rules are followed. Even so, the person would maintain their Medi-Cal here until they reach the maximum amount that could be contributed for that state. So, if the beneficiary is receiving SSI when the assets in the account total $100,000, it's going to put the SSI into suspension. If the assets in the ABLE account drop below $100,000, then the SSI resumes. The beneficiary will not have to reapply for SSI once the account drops below the $100,000 threshold, as we're going to see, as long as you follow all the other rules. So the rule for what they call indefinite benefit suspension and continuing eligibility for Medicaid during periods of excess resources here, they're going to explain it further. The special rule applies when the balance of the SSI recipient's ABLE account exceeds $100,000 by an amount that causes the recipient to exceed the SSI resource limit, whether alone or with other resources. When this situation happens, we will place the recipient into a special SSI suspension, during which we suspend the recipient's SSI benefits without a time limit as long as he or she remains otherwise eligible. The recipient is SSI eligible, remains SSI eligible for medical assistance or Medicaid purposes, and the individual's eligibility does not terminate after 12 continuous months. Normally when your SSI is cut, when you're not eligible, if you go past 12 months, you'll have to reapply all over again. The whole point of this is not to have to reapply a second time. Reinstate the recipient's regular SSI eligibility for all months in which the individual's able account balances no longer causes the recipient to exceed the resource limit and he or she is otherwise eligible. So here's an example. Paul is a designated beneficiary of an able account with a balance of $101,000 on the first of the month. Paul's only other accountable resource is a checking account with a balance of $1,500. Paul's countable resources are $2,500 and therefore exceeds the SSI resource limit. However, since Paul's able account balance caused him to exceed the resource limit, that is, his countable resources other than the able account are less than $2,000, suspend Paul's SSI eligibility and stop his cash benefits, but he retains eligibility for Medicaid in his state. Note, the SSI eligible for Medicaid purposes means that the individual is eligible for Medicaid in states under two different programs. There's what's called the 209B states and the 1634B states here. No SSI recipient will reach the suspension for many years. So basically it's telling us this is a problem for another day. So here's an example. Christine is a designated beneficiary of an able account with a first of the month balance of $101,000 in her able account, putting her $1,000 over the resource limit. Christine's only other countable resource is a checking account with a balance of $3,000. Christine's countable resources are $4,000 and therefore exceed the SSI resource limit. However, because her able account balance is not the cause of her excess resources here, the special rule does not apply and Christine is not eligible for SSI because of excess resources, not because of the able account. Suspend Christine's SSI benefits using the normal process and her Medicaid benefits will stop. Ineligibility for other reasons. If an individual is ineligible for any reason other than excess resources in an able account, the special suspension status does not apply. Suspend the individual's SSI eligibility using the normal process. Example here. In April, Sam's able account balance is $102,500 as of the first of the month. However, Sam also has excess deemed income in April and is not eligible despite the excess funds in the able account. Before the end of April, Sam leaves the United States and does not return until July. Here, Sam is not eligible for May, June, and July because you can't be out of the country for more than 30 days and remain eligible. If Sam still has excess resources in the able account effective August 1st and is otherwise eligible for SSI, place him on the special able resource suspension status. And he is eligible for Medicaid. Count retained distributions for housing or counting retained distributions for housing expenses or expenses that are not QDEs as a resource. Okay. A distribution from an able account is not income, but a conversion of a resource from one form to another. We've seen that over and over again. Count distribution for housing expense or for an expense that is not a QDE as a resource if the designated beneficiary retains the distribution into the month following the month of receipt. Basically saying don't let it go into the next calendar month. If the designated beneficiary spends the distributions within the month of receipt, there's no effect on the eligibility as we've seen, whether it's a qualified QDE, a housing QDE, or a non-qualified QDE. However, apply normal SSI resource rules and exclusions to items purchased. As I explained, an example would be purchasing a second vehicle. So here's an example here. Retain distributions intended for housing expenses that become a resource. Amy takes a distribution for $500 from her able account in May to pay for a housing expense in June. She deposits the $500 from the able account into her checking account in May and then withdraws the $500 in cash on June 3rd and pays her landlord. This distribution is a housing expense and part of her checking account balance as of June 1st. So as it rolled into the next calendar month, it became a resource, which makes it a countable resource for the month of June. So it's going to be really important for people that are using ABLE accounts for housing not to take the money out, put it in your checking account, and then hold it into the next calendar month. Count the amount of funds used for non-qualified expenses or housing expenses as a resource as of the first moment of the month in which the funds were spent if the designated beneficiary uses the distribution for a non-qualified purpose or housing expense. If an individual's intent is to use the funds for a qualified disability expense changes at any other time, but he or she has not spent the funds, count the retained funds as a resource as of the first of the following month. So here's an example of a previously excluded distribution used for a non-QDE. Sam takes a distribution of $25,000 from his ABLE account in May for an assistive technology and related service. He pays a $10,000 deposit for the item. While waiting for the service to be completed, Sam takes a trip to a local casino in July where he loses $1,000 of his ABLE distribution funds. Okay, the $1,000 he lost gambling is a countable resource in July. Notice the funds went into the account in May, but he used it for a non-QDE in July, and that's why it becomes a resource in July. The other $14,000 Sam retained is an excluded resource while it meets the requirements of this section. Here's another example here of a previously excluded distribution used for a housing expense. In June, Jennifer takes a $7,000 distribution from her ABLE account to pay an educational expense that is a qualified disability expense. Her educational expense is due in September. However, she has to make a $750 advanced rent payment to her landlord for her college apartment in August. She uses some of the distribution she took in June to make the rent payment a housing expense. The $750 is a countable resource in August. Once again, notice she took out the funds in June, and if this had all happened in June, there wouldn't be a problem. But she made the payment even though her intention originally here was to use it for educational expenses. She took that and spent it on housing here in August, and that's why it became a countable resource. Exclude the remaining $6,250 of the retained distribution while it continues to meet the requirements of this section. Here's an example of a change of intent on the use of the distribution. In June, Jennifer takes out $7,000 distribution from her ABLE account to pay an education expense that is a qualified disability expense. Her educational expense is due in September. In August, Jennifer takes a job offer and decides not to return to school. The $7,000 becomes a countable resource in September because she no longer intends to use it for an educational expense that is a qualified disability expense, unless Jennifer redesignates it for another qualified disability expense or returns the funds to her ABLE account prior to September. So here's the thing, and basically here's kind of a word of advice. I think it makes a lot of sense here that many ABLE programs have methods, including debit cards, tied to ABLE accounts that allows the person with signature authority to pay directly for their needs, eliminating the chance of this sort of problem. So the next section is something we're going to skip over, which deals with how Social Security reports data here or accepts data from the different ABLE programs, which I'm sure is fascinating to the ABLE programs, but not relevant to us. The last thing we're going to cover, though, is a new subsection dealing with debit cards tied to ABLE accounts. Many ABLE accounts have debit cards tied to them, and this is going to give us further direction. Some ABLE programs provide designated beneficiaries with a prepaid debit card, which may be used to control the issuance of distributions and provide designated beneficiary with the convenience and access of their ABLE funds. For instance, I opened up an ABLE account for my niece here, and it was part of the Ohio program, and she has a stable card. It makes it really easy for her to use that and access those funds. Social Security will receive information about the distributions via a data exchange from the different ABLE programs when monies are loaded onto an ABLE prepaid debit card. In handling ABLE debit cards in the SSI claim system, if a designated beneficiary has an ABLE prepaid debit card, record the ABLE prepaid debit card on their system. The eligibility worker or the SSI worker is going to need the program state and account number. Monies distributed to the ABLE prepaid card are considered a qualified distribution unless Social Security determines otherwise. It's suggesting to enter the intended use of the funds in the description field. Now, my understanding is this is going to be very broad here. Enter the entire alleged value as an excluded amount and as a qualified distribution when the funds are added onto the debit card, and use the new exclusion reason of qualified disability expense here, which excludes the monies on the prepaid debit card on the system. Anyway, I want to thank you for watching today. I know for myself, as the trustee of the Golden State Pool Trust, I'm really excited about this new tool, and I think for many persons with disabilities, including some of our beneficiaries, this is going to really enhance the quality of life in the correct situation. Please go back to our YouTube channel, and as you'll see, there are many other videos here that cover the ABLE program here. So this is Stephen Dale. I am the trustee of the Golden State Pool Trust. Good afternoon.